As you already know, in order to trade something, you need a product, in one way or another. Basically, it can be close to everything. So we will cover most common and the biggest ones at the same time. So in the end, you will have a general idea about these products and what financial markets really are. Of course, some traders said you don't need to know how the markets works. All you need to know how to trade them and make money from that. Well, we cannot fully agree with them. You need to know how it works. Basic principles at least. It shows your level as upcoming professional in financial markets. We cannot dig deep into every market because it would take too much time and could be separated program only about this topic. But basic principles for sure will be covered, just to have a general idea. Actually, all the markets works in the same principles, but the products are different. It is not the rocket science. Everyone should know what they are doing and what tools they are using. Imagine construction worker who doesn't know how to use his working tools. Would you ask him to build a house? So in trading is the same situation. You have to know your working tools. Basically, all the markets is the same in one way or another, and so different at the same time. So let's begin to analyze these markets. Forex. Forex, foreign exchange market or currency market, is the biggest market in the world, and in meantime, toughest one to trade, because there are so much money in this market. Daily turnover is more than 7.5 trillion as of 2022, and numbers reach higher as of today. Currency market began forming in early 1970s. Currency market is currency pairs. Currency itself do not have some fixed value, but rather determines its relative value by setting a market price of one currency if paid with another. The foreign exchange market works for financial institutions and operates on several levels. Main participants of currency market: interbank foreign exchange market, which is made up of larger commercial banks and security dealers, central banks, commercial companies, investment management firms such as hedge funds, currency market brokers, money transferring companies, remittance companies, etc. So you, as a trader, would be trading currency pairs: Euro versus United States dollar, United States dollar versus Great Britain pound, United States dollar versus Canadian dollar, etc. As I mentioned already, it is the biggest market in the world, and have huge volume, and of course, high liquidity. But also, one of the factors that affect exchange rates is high, which is not so good. For example, one of Europe countries had a huge business deal and expected payments only in euro. Since it was big purchase, it has influence on euro, and euro rises. On a chart could be big price action rise out of nowhere and against all technical odds. However, it doesn't mean that it is not possible to trade Forex. Main tradable currencies or worldwide currencies: United States dollar, Canadian dollar, New Zealand dollar, Australian dollar, European euro, Japan yen, Great Britain pound, and Swiss franc. Other than that, not so relative. Crypto. Second market to talk about is cryptocurrencies. It is quite new, gained such a popularity due to the promoters on social media, who shows what crazy amounts of money they made trading cryptocurrencies. And that is not exactly true. In most cases, because we receive a commission from referring clients to the broker, so if they offer special broker, you know what we are talking about already. Be careful about these brokers. So crypto is digital currency, designed to work as a medium of exchange through a blockchain technology, that is not reliant on any central authority, such as government or bank, to uphold or maintain it. Main crypto out there is Bitcoin and other tokens, cryptocurrencies, or other digital assets other than Bitcoin are collectively known as the alternative cryptocurrencies, altcoins. It is not that bad market to trade honestly. With right approach, good risk management, and clear strategy, you can do it for sure. Futures. In finance, a futures contract, futures, is standardized legal contract to buy or sell something at predetermined price for delivery at a specific time in the future, between parties not yet known to each other. The asset transacted is usually a commodity or financial instrument. The predetermined price of the contract is known as the forward price. The specific time in the future when delivery and payment occurs is known as the delivery date, because it derives its value from the value of underlying asset. The futures contract is derivative. Contracts are traded at futures exchanges, which acts as a marketplace between buyers and sellers, as both parties risk their counterparty reneging if the price goes against them. The contract may involve both parties lodging as security a margin of a value of a contract with a mutual trusted third party. For example, in gold futures trading, a margin varies between 2 to 20%, depending on the volatility of the spot market. The spot market, or cash market, is publicly financial market in which financial instruments or commodities are traded for immediate delivery. A stock futures is a cash-settled futures contract on the value of a particular stock market index. Stock futures are one of the highest trading instruments in the market. Stock market index futures are also used as an indicator to determine market sentiment. The first futures contracts were negotiated for agricultural commodities, and later futures contracts were negotiated for natural resources such as oil. Financial futures were introduced in 1972, and in recent decades, currency futures, interest rate futures, stock market index futures, and cryptocurrency inverse futures, and perpetual futures have played an increasingly large role in the overall futures market. Even organ futures have been proposed to increase the supply of transplant organs. However, futures contracts also offer opportunities for speculation, in that a trader who predicts that the price of an asset will move in particular direction can contract to buy or sell it in the future at the price which will yield a profit, if the prediction is correct, of course. In particular, if the speculator is able to profit, then the underlying commodity that the speculator trade would have been saved during the time of surplus and sold during the time of need, offering the consumers of a commodity a more favorable distribution of commodity over time. Stock market. A stock market, equity market, or share market is the aggregation of buyers and sellers of stocks, also called shares, which represent ownership claims on businesses. This may include securities listed on a public stock exchange, as well as stocks that is only traded privately. Trade in stock market means the transfer, in exchange for money, of a stock or security from a seller to buyer. This requires these two parties to agree on a price. Equities, stocks or shares, confer an ownership interest in a particular company. In simple terms, stock is a part of a company. Reason why stock market is a great place to trade, because there are so many stocks out there, and you can choose whichever is relevant to you based on your analysis. In other words, you can look for perfect structure, and if there is something you do not like about the stock, there is thousands other stocks to trade. The movements of a price in global, regional, or local markets are captured in price indices, called stock market indices, of which there are many. For example, S&P 500, the FTSE 100, the Euro Stoxx 50, DAX 40, Nikkei 225, and many more others. Such indices are usually market capitalization weighted, with the weights reflecting the contribution of a stock to the index. The constituents of an index are reviewed frequently to exclude stocks in order to reflect the changing business environment. Indices is a great place to trade and also a great place to invest. It is one of the safest places to invest money to. Return will be not big, of course, but at least will cover inflation. Way better to keep money in indices than cash. Remember, cash is trash, unless you put it to work. Commodities. A commodity market is the market that trades in primary economic sector rather than manufactured products, such as cacao, fruits, and sugar. Hard commodities are mined, such as gold and oil. Futures contracts are the oldest way to invest in commodities. Commodity market can include physical trading and derivatives trading using spot prices, forwards, futures, and options on futures. Farmers have used a simple form of derivative trading in the commodity market for centuries, for price risk management. ETFs. An ETF is called an exchange traded fund because it is traded on an exchange just like stocks are. The price of an ETF's shares will change throughout the trading day as the shares are bought and sold on the market. ETFs tend to be more cost effective and more liquid compared to mutual funds. An ETF is a type of fund that holds multiple underlying assets, rather than only one like stock does. Because there are multiple assets within an ETF, they can be a popular choice for diversification. ETF can thus contain many types of investments, including stocks, commodities, bonds, or a mixture of investment type. An ETF can own hundreds or thousands of stocks across various industries. Or it could be isolated to one particular industry or sector. Some funds focus on only United States offerings, while others have a global outlook. For example, banking-focused ETFs would contain stocks of various banks across the industry. As you get the general idea, ETFs commonly used for investing and not trading. However, it can be used for day trading as well. Bonds. The bond market, often called debt market, fixed income market, or credit market, is a collective name given to all trades and issues of our debt securities. A debt security is a type of financial asset that is created when one party lends money to another. For example, corporate bonds are debt securities issued by corporations and sold to investors. Investors lend money to corporations in return for pre-established number of interest payments, along with the return of their principal upon the bond's maturity date. Governments typically issue bonds in order to raise capital, to pay down debts or fund infrastructural improvements. Publicly traded companies issue bonds when they need to finance business expansion projects or maintain ongoing operations. The bond market is broadly segmented into two different silos: the primary market and secondary market. The primary market is frequently referred to as a new issues market, in which transactions strictly occur directly between bond issuer and bond buyer. In essence, the primary market yields the creation of a brand new debt securities that have not previously been offered to the public. In the secondary market, securities that have already been sold in the primary market are then bought and sold at later dates. Investors can purchase these bonds from a broker, who acts as an intermediary between the buying and selling parties. These secondary market issues may be packed into form of pension funds, mutual funds, and life insurance policies, among many other product structures. Again, bonds are safe investment, so return cannot be high as well. You can trade bonds also, but it is not so volatile, so you have to have appropriate expectations. Option. The term options refers to a financial instrument that is based on the value of underlying securities, such as stocks. An options contract offers the buyer the opportunity to buy or sell depending on the type of a contract they hold, the underlying asset. Unlike futures, the holder is not required to buy or sell the asset if they decide against it. Each option contract will have a specific expiration date, by which the holder must exercise their option. The started price on an option is known as the strike price. Options are typically bought and sold through online or retail broker. How it works. If we talk about investing in any of these products, it's easier. You buy the product for existing price at the moment of deal and hold it at least for a few months, up to a year or even longer. Not Forex, of course. Forex is cash. Cash you have anyways. You need to get rid of them. If we made correct analysis, the product we bought rose, thus making a profit for us. Simple as that. Let's talk about trading right now, and it is completely different story. In trading, we use leverage, and positions are held anywhere from few minutes up to a few days, but no longer than a week for most of the time, and depends on your strategy. Just to make clear, investing and trading is completely different, and only fundamental knowledge could be useful for both. So do not even compare those two things. Trade calculation depends on your risk, of course, but just to have a general idea how it works, let's have a look into calculations, starting from Forex. For example, suppose we have 1 to 50 leverage. It means that we can trade 50 times bigger amount that we have. Leverage size depends on your broker, and at some you can choose whichever is better for you. But for Forex, usually you get fixed leverage, and it could be anywhere from 1 to 30 to as crazy as to 1 to 500. In Forex, each contract size is 100,000 euro or dollars. For example, you buy or sell 100,000 of euro versus dollar currency pair at 1.1236. And since your leverage is 1 to 50, you have to cover one part of 50 price of a contract, which is 2,000. That amount of money you need to have just to open a position. And for example, price climbed from 1.1236 up to 1.1239. That leads to $30 of profit. That is just pure calculation without any broker commissions. Currency market moves way more than an example, so you can make shitloads of money if you would be right at your bets. And of course, you can use smaller contract size, like 0.1, or some brokers allow us to do even 0.01 contract size. It means, with the same leverage, margin requirement would be only 20 euro or dollars, but profit would be way smaller, of course. Just to make clear, margin is the amount of capital required your account to start a transaction. Each time you open a position, a certain percentage of your capital or balance in your account will be withheld as a margin for opening a position. But it is not a transaction cost. It is a portion of funds that broker sets aside from your account balance to keep your trade open and ensure you can cover potential losses. Of course, you need to have bigger balance in your account when margin. Let's talk about stocks now. Trading stocks, you will not get such leverage as trading Forex. Usually, leverage is in between 1 to 2 to 1 to 10. Of course, it depends on broker, and some offers to choose whichever you like. Let's say you have or chose 1 to 5 leverage, and you have $10,000 account balance, and looking to trade stock, which is $20.5 value at the moment of trade. You made your analysis and expecting stock to rise to 21.25. Accordingly, set stop loss to 20.25. And your take profit will be 21.25. But how many shares should you buy? Question is. In case of success, a return will be 75 cents. Let's say you bought 400 shares, which value is $8,200. But you have leverage 1 to 5, so margin requirement will be 1,640. If take profit would be reached, your profit will be 21.25 times 400 minus 8,200 equals 300 from a single trade. Accordingly, if stop loss would be reached, you will expect loss of 100. Everything relies on your risk tolerance. With this example, you were able to buy 1,600 shares, but risking to lose way more money on a single trade, and it could affect your further trading as well. So trading stocks, you buy large quantity of shares in short period of time, with leverage. Well, it is possible not to use leverage at all. But in this case, you need to have large account balance, which is not for everyone at the beginning. In similar way, working crypto trading. You choose your leverage, quantity of crypto would you like to buy or sell, so we will not get into details here. Futures. Futures trading is way different than stocks trading or Forex. Different futures products has different details. So before start trading, you need to know the most important factors, especially when it comes to point value, calculations, etc. First of all, to trade futures, you need to have quite a large amount in your trading account, because it is an expensive thing to trade. But there are mini or micro futures, which is more reliable at the beginning. Let's get back to the margin term. Securities margin is the money you borrow as a partial down payment up to 50% of a purchase price to buy and own a stock, bond, or ETF. This practice is often referred to as a buying on margin. Futures margin is the amount of money that you must deposit and keep on hand with your broker when you open futures position. It is not a down payment and you do not own the underlying commodity. Maintenance margin is the minimum amount that must be maintained at any given time in your account. If the fund in your account drops below the maintenance margin level, a few things can happen. You may receive a margin call where you will be required to add more funds immediately to bring the account back to the initial margin level. If you do not or cannot meet the margin call, you may be able to reduce your position in accordance with the amount of funds remaining in your account. Your position may be liquidated automatically once it drops below the maintenance margin level. The value of futures contract is derived from a cash value of the underlying asset. While a futures contract may have a very high value, a trader can buy or sell the contract with a much smaller amount, which is known as the initial margin. Trading futures contracts is different than trading stocks due to the high degree of leverage involved. This leverage can amplify profits, but also losses. The initial margin is the initial amount of money a trader must place into account to open a futures position. The amount is established by the exchange and it is percentage of the value of a futures contract. For futures contracts, exchanges set the initial margin requirements that can be as little as 3 to 12% of the contract to be traded. Stock indices futures. Futures on DAX 40 are bought and sold on the Eurex exchange. The value of DAX 40 futures contract is equivalent to 25 times of the current price of contract in euros. The settlement date, also known as the expiration date, is always the third Friday of the representative contract month, which is March, June, September, or December. For example, DAX 40 is priced at 18,000 euro. Value of contract is 450,000 euro, which is very, very expensive. However, margin would be around 50,000 euro, which is still quite expensive. At the DAX futures, each point value is 25 euro. It means that any given trade, if you expect to get 90 points, your return will be 90 times 25 equals 2,250. And sometimes DAX can jump 90 points in a few minutes. It is a high risk trading product, but with the right risk and money management, it is possible to trade without any problems. Crude oil example. A crude oil futures contract on the Chicago Mercantile Exchange CME is for 1,000 barrels of oil at $85 per barrel at this moment. The national value of a contract is 85,000. A trader, however, is not required to place this amount into account. Rather, the initial margin for crude oil contract would be around 10,000 per contract, as determined by the exchange. This is the initial amount a trader must place into account to open a position. Thanks so much for watching, and if you found this video helpful or interesting, please give it a thumbs up. It really helps the channel to grow. And if you like to see more content like this, make sure to subscribe and hit the notification bell so you don't miss any future videos. I would also love to hear your thoughts or questions in the comment below. Thanks again, and I'll see you in the next video.